Today is Tuesday, April 18th, 4:15 p.m. Eastern Standard. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. What's up, Pam? What's up, Bandit? Tate, Nick? Position disclosure. I got out of Bank of America today. I bought and then got out of Roku. I traded some Microsoft today. I didn't keep any of that. Traded some TNA today. Didn't keep any of that. Yeah. So Netflix. Wow, what a bounce back off those lows. We were below 300, I think, right? Chart. I almost can't even see that far on my chart. The numbers didn't look terrible. The guidance was a problem. So this is going to be one of those interesting reports, and I think I was saying this yesterday, where it's not, guidance is what matters most. The guidance isn't good. The stock sold off on it. I'm really curious to see how they end up closing this thing like tonight, tomorrow, and just how bad it is off that miss on guidance. Sounds like their advertising segment is increasing. I don't know what expectations were on that. Engagement on our ads tier is above our initial expectations. That's a great headline. And as expected, we've seen very little switching from our standard and premium plans. The majority of our year-over-year FX neutral revenue growth in Q2 is expected to come from growth in our paid membership base. Yeah, curious to see how this Netflix ends up. I didn't trade it. I thought about buying some beneath 300. I was just doing too many things at once. Our Q's down right now. Not too bad. Q's are down 40 cents from the close. It's really not too bad. Okay. We will, interesting. We will keep an eye on Netflix here and what it does. Let's go over to the charts. Let's talk about today's market. All right, so we had a pretty big gap up that failed in this marketplace. Let's talk about why that happened, if we could have seen it coming, what the play was off of that. So my morning meeting today was very bullish, and the market didn't go up. Was I wrong? Maybe based on what I said in the morning meeting was incorrect. Did I lose any money off of it? No, because of the game plan that I had established to get confirmation for that bullish continuation. So as of right now, including an after-hours downtick, SPYs are flat, Qs are down small. Again, that includes the after-hours downtick. And the IWM had some relative weakness today, down 0.44%. Going over to our charts here, again, market just looked extremely bullish coming into today. We were gapping above the inside day. Whenever you're gapping above the inside day, the fact that you're above the inside day at the open is not enough. You need to see the market actually hold up above the inside day high during the day to be able to get confirmation. But the really interesting thing about today was where we're opening in relation to our resistance levels, our resistance areas. So we've spoken about, 415 to 420 is a big resistance area. I think that if you really wanted to try to narrow that down to a specific number, it would probably be SPX 4200. Has been something that there's a lot of eyes on. It's been big resistance. That February high just barely ticked above that 4200. And I think that 4200 roughly lines up with SPY 416. That's kind of what I was seeing this morning. So gapping above the inside day, gapping above 415, getting into that resistance zone, potentially getting confirmation from the Qs and the IWM was all looking pretty good, but we really need to see that the SPX could actually get above 4,200 after the market's not extended anymore on the 5-minute chart from the gap, which we're opening up with upside extension because of that gap, and at the same time that the IWM is getting above 180 and the Qs are continuing to hold above 320. That's kind of our if-then statement. If we can see all that come together, then maybe this market gives real bullish technical continuation, gives me a bit of a bit of a squeeze. So the high I'm not sure what you're referring to now, but I'm mentioning the February 2nd high. So SPX 4200. I don't have a chart of SPX, so I can't show you that. But the SPX is the cash S&P. I just got the SPY, which is the ETF that represents the S&P. So we got the big gap up this morning, and again, gapping above the inside day is not enough. You need to hold above the inside day. We need to clear SPX 4200, which I'm saying is roughly 416 for the SPYs. The high of the day for the SPYs is 415.72. You can see pre-market. If I go to the pre-market chart, we're actually a little bit higher than that. The pre-market high is 416.06. So pre-market, we were really flirting with that $4,200 number. We were never actually able to get above it for SPX. But the biggest thing I wanted to see in the beginning of the day, like I'm referencing, is how the market handles the upside extension from the gap. If the market can handle the upside extension from the gap properly, if we go sideways, if the ADMA catches up, and then we're applying upside pressure on 416, 4200, that's the signal that I'm looking for. Look, going over to the Qs getting above 320. That's kind of the area that I'm narrowing our resistance zone into, but really that resistance zone is like 319 up to this pivot high of 321.63. The fact that we're gapping above 320 is great. I need the market to hold above 320. I need it to hold above the inside day high, satisfy the small time frame extension that's coming from this 5-minute chart from the big gap, and then go. Finally, on the Russell, 180 is the key spot. Pre-market, we're not quite at 180, but we're strong pre-market. It looks like maybe we can go after it. Where the IWM eventually opened up is around 179.63. 179.63 is the high, and this sold off instantly. So I guess just to repeat myself, what am I looking for bullish confirmation from this market to show that the breakout can happen? And then if we want to go back to the if-then statement, I believe that if the market can truly clear and hold above, if taking above is never enough, hold above the key resistance levels, then you might get short squeezing coming into effect, performance chasing coming into effect, and further upside price continuation that kind of comes from those flows, as well as new technical buyers that are entering the market. None of that happened. None of that happened. The bullish case was thrown out the window pretty quickly. The first warning sign, like very often came from the IWM. How many times have we seen this IWM be the leader? This situation that we've been in post-SVB, where the IWM has been relatively weak and the Qs have been relatively strong, and I've been looking for the IWM to actually play catch-up on the bull side to the Qs, has been the first time I thought that could happen this entire year. It hasn't happened on any time frame. On big time frames, in all of 2022, whenever on the big time frame the IWM starts to lead a direction, the SPYs and the Qs have been following. The small time frame, it's been the exact same thing. When the IWM starts really failing on the small time frame, it becomes very difficult for the SPYs and the Qs to be able to perform at all. It's been a consistent leading indicator. Today was the exact same thing. Off the open, pre-market, we had a little bit of IWM relative strength. Bank of America, decent earnings report, was set to gap up. Though I had mentioned Bank of America being in day 3 was probably not something that we're looking to buy here, and I liquidated my position actually on it pre-market. The Qs were weaker to the IWM initially, I think when we were doing the meeting, and then very quickly had a flip. The signal came from this IWM failure in conjunction with just terrible breadth. There were like no stocks performing well. I'm looking at the Qs like making this high here, and I'm looking at the SPYs kind of holding in the beginning of the day and also ticking highs here at 9:45. But I'm looking at the vast majority of stocks that I'm looking at selling off, filling their gaps, going negative. It was the Apple and Nvidia show. Apple was a monster off the open. We actually discussed an Apple long today on the Inside and Up in conjunction with the India news plus the savings account news They came from yesterday, which anecdotally, it seemed like there's a lot of people trying to sign up for that Apple card, and it's a big push on Apple to actually get into finance. They're working with Goldman Sachs on it. So Apple just absolutely moving in a huge way. NVIDIA this morning was a monster, and semis can often be a leader, but everything else you're typing up was like kind of garbage, and it was more represented by this IWM. So first 5-minute candle is a warning signal. It's not necessarily the end of the world yet. There was a real chance here for this market to turn around for the IWM, to regain some strength, and then for the SPYs and Qs to continue to go sideways into bull flag and satisfy the gap and then go after resistance. The second bar here after the gap fill into the ADMA was an inside 5 and up. An inside 5 and up is one of the ways in which a negative Maribozu, which is what the first candle is here on the day, can get negated. So, alright, I'm paying attention to the fact that the IWM is selling off real hard in this first 5 minutes. Not necessarily the end of the world to me, because I know in order to be able to get market continuation, I need correction first because of how big the gap was. So, right, IWM, do I love relative weakness in the Russell? Absolutely not. Not necessarily the end of the world to gap fill and then inside bar and up. You look at SPYs going sideways, okay, they're technically building out a bull flag. They need a lot of time. The gap's really big. This ADMA is far away from that 415. It's going to take time to get there. And then the Qs here, similar situation. Apple's obviously leading. It's very extended. It's going sideways. It's holding in really well. Seeing the Qs kind of break out of this pattern very early. I think I even commented that the 2-minute ADMA had caught up, and I hate 2-minute charts. I really never look at charts less than 5 minutes. I would actually reference the 2-minute real quick because I was just curious. So I looked at my 2-minute and I was like, oh wow, look, Qs are either it's a trap or the Qs are extraordinarily strong here, or they're breaking out with the 2-minute catching up. So it's like, all right, if this IWM can give this inside 5 and up and then eventually recapture highs, if SPYs and Qs can keep going sideways and that ADMA can catch up, the breakout can still be on the table. But the final throw in the towel situation for momentum bulls that were looking for a breakout, in my opinion, was when the IWM made new lows at 950. Once this Russell made new lows, this inside 5 and up is now failing. We're failing to negate this negative Maribozu. Breadth is looking terrible. It's only Apple and NVIDIA that are actually performing. That was it. The idea of a potential technical breakout on a big picture from the market was just shot at that point. So for me, in the beginning of the day, I'm really proud of myself for how well I followed my game plan. I didn't do as good as Pat did. Pat absolutely coming out and calling tops in NVIDIA. NVIDIA is trading below 280, and Pat's like, yeah, I want to see it above 281, maybe mid 281s to be able to get that short. Crushing NVIDIA to the short side, crushing the Apple extension to the short side. So maybe I didn't do as good as Pat today with the recognition of that extension and coming in on the other side of the trade, but I'm proud of myself for following my game plan. The game plan was, and I think that a great way to look at markets in general is in terms of if-then statements. I've got the potential of a really big picture breakout for the market here. We're gapping up. We have an inside and up. The daily charts are not extended. We're testing huge resistance levels. And I did also say in the back of my mind in the morning meeting, a little bit nervous that the market's not going to be able to do this right in front of earnings season without first seeing what Netflix, Apple, Amazon, Microsoft look like. But if I can get the technical confirmation, then let's go for it. So, Josh, so waiting, being patient, didn't jump the gun, was not aggressive on longs off the open when the market's this extended. I'm waiting for that confirmation. I'm waiting for that ADMA to catch up on a time correction. I'm waiting for this IWM to show me that it can clear up and be able to give continuation. And I just never got it. So, beginning of the day, while I was bullish, I was patient. So I never got hurt at all by being bullish. And then I went from patient to market is telling me that the thought process is failing, and now there's nothing for me to do. And that really happened by 950. By 950, it was just, and I think it was even saying on the radio, I'm sorry guys, I just don't have anything for you here. I don't want to come in and buy this market when it's showing me that it's failing, but I don't really want to come in short what is still such a strong market from the big picture. So I was very not aggressive today. Didn't necessarily do a lot of volume. You know, didn't press things. I took that Microsoft trade that I had called out. Microsoft was actually weaker. It price corrected here, but Microsoft had, you know, a little bit of news that those price target increases. It was potentially in play. 290 is a key level. Sure, it's losing 290, but I don't care if a stock is really losing the level if the ADMA hasn't caught up yet, which is that equilibrium area. So you got that pivot there. I went long off that pivot a little bit early, honestly, than I felt comfortable doing because the ADMA hadn't caught up to lows yet. I think I bought like 50 cents risk initially, and then I averaged down at somewhere around 289.50, and I was able to get this pop all the way up to 290.72. So more than enough of a move to actually be able to cover risk, and actually even more than cover risk on the trade before that thing eventually totally failed, you know, with the market. So I did try that, even if I was being a bit patient, and I took it with decent size too. We just really made sure to keep my stop in with the thought process of I'm going to need the cues to at least go sideways, Microsoft to create this pivot, the ADMA catch up to the pivot, and the stock get above 290 in order for it to work. So kind of tried that one and got pushed out of it, and then I didn't really do very much. You know, I took a little Roblox off 40 one time and made 50 cents on it. I got back into Roku that I had liquidated yesterday around 60, you know, I think below 64, and liquidated that into the close at around 65. You know, I traded some of this TNA. I traded some of this IWM as it was coming into 178, but my game plan and my thought process, as I mentioned, was I'm going to start real small. I'm going to keep it a little bit loose, but I'm going to look to kind of range trade it a little bit because I didn't think that the market was going to give a full breakdown either. So when the IWM was getting to that 178, I was like, all right, I'm going to nibble on a little TNA. I liquidated almost my entire position into this move. I rebought the stock kind of into these lows here, kind of worked it the rest of the day and liquidated my position in the close. I ended up making a few bucks on that one and managing my swing positions. And that's it. You know, just a not super active day necessarily, but I had a game plan in place. I was looking for the market to confirm and to give me the signal to be more aggressive to buy. It never did it. I pulled away. I sat on my hands. I managed risk. And at the end of the day, you know, because some of my swing positions are against me a little bit, I'm down small on my P&L, and I'm plenty happy about it. I didn't overtrade. I didn't fight the market. I didn't think that my thesis on the day has to be correct because I had that thesis when the market is not confirming it. And I think that's kind of the lesson of the day, at least from my end. And even as I look at my P&L today being down small, including some swings that were against me, I think I could have traded better, to be totally honest. So so yeah, so that's all I got. Thanks, Smoke, Cold Smoke. I appreciate it. Happy to answer any questions that anybody has. Where's Netflix? Netflix, solid bounce back. If this Netflix is going to stay negative, it really shouldn't be able to get back above 330. I haven't been following it closely. Haven't been watching the tape, but I don't hate the idea of trying to put on a cute little short versus 330 in this area. And then if it pulls back down, you could just use this pivot high as a stop loss. But that's an impressive comeback from Netflix on not so great earnings guidance. All right, over to questions. First thing I'm seeing here is from Kyle. So I took Microsoft trade as well this morning as it was hammering off the ADMA. All right, cool, we're in it together. Bought back stock through 290. Yeah, at a better price. Oh, just like that, Netflix is about to break up. My first entry was like 289.80 something. But anyway, I bought back through 290. I got a little bit of slippage, so I was never able to get the risk covered on the little grind higher after. Could you explain how you went about trading this? I remember hearing in the VTF that you got your risk covered and sold some more. Yeah, sure. So one thing that you want to be able to do is so if you're taking a lot of space risk on the trade, like you're buying 290 plus some slippage with a stop loss at 289.21. You're taking a lot of space risk there. You got 80 cents worth of space risk, assuming you got 290 and you got a little bit of a worse price than that. So you need to move all the way up to 290.80 to be able to get to your 1-to-1. That's not terrible on Microsoft, to be honest. We're talking about a $300 stock. $300 stock that can move a little bit. Don't really want to take over $1 risk in Microsoft, but if you're able to keep it under $1, I think it's not terrible. But I like to be able to leave in a little bit of room if I have a decent amount of space risk to average down the position on how much I want to risk on the trade. So, let's say that you wanted to risk, I don't know, like $300 on your trade. I'm just trying to come up with a simple number to try to do some easy math. Let's say you bought 200 shares at 290. Stop loss is going to be at that low, so you got $160 of risk there. In this case, and maybe 300 is a little bit too much if you're only taking 160 initially. I want to leave some room to be able to double down. So if you're taking that $160 of risk initially by buying 290, and it pulls back like it did on this next bar, as a general rule, the better the risk reward, the lower the probability of success. So just the fact that it pulled down on the second bar, when this was pulling back down on the second bar and put in a low of 289.33, I thought I was actually going to get stopped out right then and there. But I still bought some more stock at about 289.50. And off of that, I've got, and I actually probably should have gotten a slightly better price, but I'm just telling you what I did. I got some stock at 289.50. So off that add, I've got 30 cents worth of risk. So if you bought 290 and you're risking $160, and then you added 289.50, and let's say you did 200 shares there, so you're doing 200 shares here, you're adding on an extra $60. So now your total risk on the trade is going to 220. It's a relatively small percentage increase on the initial risk that you are putting on. It should be built out into the game plan from the beginning that you don't mind risking, you're risking $250 on the trade or whatever it is. But it gives you the opportunity to kind of work the position a little bit more, bring your average price down. And then from that point, there's kind of two ways that you can go about it, and I don't really have a rule on which way I do it because the math kind of works out the same. You can treat those as two separate trades, which is what I do a lot, or you could treat it as an average price. So if you're doing that as an average price, now you've got 400 shares from 289.75, so you are risking 55 cents on it. So you now just need to move to 290.30 to get your 1-to-1, as opposed to, so now you just need to move to 290.30 as opposed to you originally needed to move to 290.80. That's significant. There's a much higher probability of you getting that fill at 290.30, of getting that fill at 290.30 and then getting stopped out and now having a break-even trade than getting the fill at 290.80. And you're getting that opportunity to be able to do that and to potentially have more size also on the trade, which is an added benefit, with, again, a relatively minimal percentage increase on the overall risk. So you average down in front of your out. A great way to go broke is to average down to 0, is what they always say. But averaging down in front of a stop loss to work the position is something I advocate when you've got a lot of initial space risk. So if you did that for that extra $60 worth of risk, your trade would have been break even. You could have sold 200 shares at 290.30 into this pop. You would have gotten stopped out, and you actually would have doubled your core position if the trade worked, which is also kind of cool. Instead of, you bought 290 on the way up, you got 200 shares, you sell 100 shares at 290.80, you get a 100 share core position. Now you bought 200, you sell 200 at an even lower price, the risk is covered, and you've got double the core position. The other way that you can do it is I got 200 shares from 290, so I'm going to leave an offer for 100 shares at 290.80, and I've got another 100 shares with 30 cents risk at 289.50, so I'm going to offer that at 289.30 and try to get a 1-to-1 on each buy. I do both. It kind of depends a little bit on the situation. In this situation, I was looking a little bit more at my average price when I was kind of booking it, so that, again, because I had a little bit of a better price than you. I think I bought 289.85, and then I bought 289.51. So I was able to, sell some stock into the up move, and then I sold more stock at 290.49. So I sold more than 50% of my position into that up move that went up to 290.72. So that's what I did, and again, from a game planning perspective, it's just a way to be able to work the trade, and I specifically like doing that when you have a lot of space risk to begin with. I like the idea of adding down in front of your stop loss for marginal increased overall dollar risk on your trade, but a much greater ability to game plan and work the position so that if you get a certain situation exactly like this Microsoft situation, this is a failed trade. But taking the one buy at 290 versus taking the buy and taking the add is the difference between your failed trade being a complete full loss loser and it being either break even or even potentially slightly profitable, depending on how you took the trade. So, hope that helps, Kyle. Happy to answer any clarifying questions. Awesome, Nick. I love that you're on both sides of that Apple trade. That's amazing flexibility. I've always found that to be one of the most difficult things to do as a trader, is to be able to work both sides. To be able to be long and then flip. It's really difficult because when you're in a position, you're very focused on the long side of that trade working, and you might even recognize, hey, this is a great spot to get out of my long position or book profit on my long position. But coming in on the complete opposite side and saying not only is this a spot where I should get out of my long, but it's also a spot I should short is solid. Netflix all the way back. Wow, look at that. Yeah, so awesome. Great job. From Tate, when reading earnings numbers we get in the virtual trading floor, is there certain things that catch your eye first, try to look for constantly, or is every earnings report you just skim out what the stock is moving, then going back over to skim over the example of revenue if guidance is a big catalyst? Maybe this is another question too, but someone who has been a trader for a short amount of years, how are you able to identify the extent misdirection off earnings, say selling on good numbers and guidance? Okay. Think I understand your question, and I guess as we're coming into earnings season, I haven't really spoken about earnings season yet as we come into this one, so it's probably worth going over some information here. Let me start with the ultimate beginner mistake that I've seen many people make over the course of the years that I really don't want anybody to make. The ultimate beginner mistake that new traders really make in earnings season that I really don't want to see anybody make is they see a company crush all their numbers and they think the stock has to go up. It beat on earnings, it beat on revenue, it guided higher, every piece of the number looks like a beat. You're buying the stock because it has to go up, and you get absolutely crushed when it doesn't. The stock comes down, it fills its gap, it goes negative, you bought highs. Stocks do not have to go up because they beat on their numbers. There's a lot of information that's going on, and you never know how the big players are actually going to be able to react, or how they're actually going to react to an earnings report. Because first thing is, when a company beats or misses on earnings and guidance, what are they beating or missing? They're beating or missing the average sell-side analyst. But don't get me on a tangent on analysts today because I'm tired. Sell-side analysts are useless. They're useless. Yet I pay attention to upgrades and downgrades every single day, right? Because it puts stocks in play. But if they were great, they wouldn't be analysts. I know that there's a lot of chatter from Brandt, some sarcastic chatter in the VTF earlier this morning about the HSBC analyst who covers NVIDIA, who had the stock as a sell at 100 and now has just flipped the stock to a buy at $280. Like, congratulations to that person. You're really worth your salary. So you're beating the average sell-side analyst estimate on earnings. But what you don't know is what the top 5 shareholders of, let's say, Netflix are actually looking for on the earnings report, because they probably have different internal numbers that they have developed from the average sell-side analyst. And sometimes you call that a whisper number if it's able to be known, but a lot of times you can't know what shareholder number 7 of Netflix, the 7th biggest holder of Netflix, is actually looking for from this earnings report. Or maybe it's a beat on the average, sell-side expectations, but you don't beat the 7th biggest holder's expectations, and then when the stock gaps up, that holder is dumping stock the entire day, and the stock sells off and goes completely negative. So do not make the mistake of just seeing, oh wow, company beat on the report, it has to go up and I'm going long. Absolutely not. With that said, more often than not, if a company beats on every metric, it is going to go up. More often than not. But it's going up almost immediately as a result of the reaction. So you also then have to be like, all right, well, this company beat on every metric and it's opening up 7%. Is that 7% reasonably pricing in the beat on the metric? Should this thing be able to be up 15%? Should it only be up 3%? And that's very, very hard. That's very, very hard to be able to do that. The technicals confirm it, so we get an idea. You want to take a look at the earnings report. If it beat across the board, you want to note that. If it missed across the board, you want to note that. If there's something particularly interesting in there, you want to note that. But don't overly make assumptions that a stock has to go up or has to go down just because of a report. Pay attention to what those numbers look like, and do it in conjunction with how the stock itself is actually trading. A great general rule for earnings names specifically is to trade them in the direction that they're moving. Like those great trades that Pat was calling out in NVIDIA and Apple today, basically at highs to flip short or to be short. That's a much, much more difficult trade in a news event like an earnings report. In a news event like an earnings report, like that Teladoc today, which apparently had some news. I didn't look at it after the open. That opening move in Teladoc was nuts. You easily could have come in and shorted that too early and gotten wrecked. When there's a news event going on, it's much easier for an extended stock to become significantly more extended. So great general rule is to trade earnings names in the direction in which they're moving. Now going back, I guess more specifically to your question, usually the most important thing is the guidance. Earnings revenue from last quarter is great. It's notable. Pay attention to it. But usually the most important thing is not what they've done in the past, is what they're planning on doing in the future compared to expectations. Other big things I really like to pay attention to are buybacks and dividend increases, especially buybacks. Really big buyback news or increases can have a really large effect on a stock. To the point where you could have a stock that misses on guidance, and that would be very bearish, but in conjunction with that, they're announcing an unexpectedly large buyback, and that ends up totally negating the fact that the guidance was no good. So I'm paying attention to that. And then after that, it's just kind of broadly stock-specific things, important company update-related thing. I remember Macy's one time had a not-so-great-looking earnings report on the surface of it, but they crushed their digital numbers, and this is probably a few years ago now. They absolutely crushed their online sales and digital numbers, and I remember saying in that morning meeting, I was like, look, these Macy numbers aren't good, but if the market confirms it, I really want to go long this thing. I think it can work its way higher, because I think all the market's actually going to care about is not that they missed on their numbers, but that the online sales look so awesome, and that's the future, and that's how they're competing with Amazon. And that's a very stock-specific example, and I ended up being right, and I think I was involved in Macy's that day, and I was able to do really well with it. But that's kind of broadly what I'm looking for, and I guess that's my thought process as we come into earnings season here. Cool. Yeah, and you also just want to be careful when you're trading earnings reports, when you're trading earnings names, even during market hours, let alone after hours. Even during market hours, you want to be careful. You want to recognize that the stock that you're looking at is going to be moving most likely significantly faster than you're used to it moving. And that breeds a lot of potential opportunity, but it also creates a lot of risk if you're not fast in the keys, if you don't know where your stop loss is, if you're not getting your stop loss out in time. Google to launch its first phone, foldable phone. Cool. What else do we got here? Sebastian, what do you think about FSLR? Is it actionable? How did First Solar hold in today? First Solar got downgraded again this morning, right? First Solar got like its 4th downgrade in this range and once again held up like an absolute champion. What did that Sunrun do today? Ooh, they sold it down. They sold off Sunrun that got upgraded, and they held up First Solar that got downgraded. This First Solar is a monster. Inside day today, 220 is an important level. I think this is one worth keeping on the radar for tomorrow. From Rex. When we are trading a stock that is more market dependent, the single stock that we are trading is looking good, but the market looks like it's not on our side. How do we make sure the trade would have a higher probability to go in our favor? Well, it automatically has a lower probability of going in your favor if you're long the market. Sorry, you're long a stock and the market's going against it. For example, Qs this morning sold off really hard from 955 to 10, but Nvidia only had a small pullback, so it's relative strength. And held above the opening low. Yeah, into that pullback with those moving averages being there. So I kind of, looking at the market side, if the market is ever going to pivot, that Nvidia can go. That's exactly the right thought process. Nvidia formed an inside 5. I see it just after 10 there. However, the market was still heavy on the sell side. Coincidentally, the market made a pivot at 10:35 and ended up saving my trade. For me, this looks like a 50-50, even with the stock being relatively strong. If the market continues to go down, the relatively strong stock would turn out to fail and stop you out, for sure. Yeah, for sure. So, I mean, look, these are the layers of probability. And you could take your layers of probability and you can rank them all. Bullish, bearish, neutral, right? So you could say Nvidia not in play today, no news. So that's neutral or potentially against your trade. Nvidia relatively strong, that's on your on the side of your trade. Market weak, that's against the side of your trade. So you just want to recognize all those things more than anything. You know, you want to recognize like, okay, like Nvidia is really strong here. If I could get this market to pivot, and maybe you have a reason to believe that the market can pivot, I want to be long Nvidia because it's going to probably work its way back above 280. It's a very sound thought process. But if the market doesn't pivot, or you don't have any reason that the market should pivot, or you think the market's going to continue to go down, it doesn't matter how relatively strong Nvidia is, it's eventually going to stop you out. So, I mean, I think that you're saying everything correctly here. The question that you're trying to judge is, one, do you think that the market can pivot? I think that really, if you think that the market can pivot, then this Nvidia all of a sudden becomes potentially an excellent trade. If you're uncertain, or you don't know, or you think it can't, then it's not nearly as good of a trade. In the first situation, you probably want to be in it. If in a situation where you're not sure, maybe you still want to be in it, but for less risk. In the third situation where you feel really confident that the market's going to continue to sell, then you probably don't want to be in Nvidia at all despite the relative strength. So, you know, it doesn't have to be all or none, right? You can be heavy, lighter, or not in at all, depending on how those different layers of probability are kind of playing out. I hope that makes sense. All right, gang. Anything else for today, or I'll wrap it up? Netflix all the way up. Whew, positive now. I have to take a closer look on that. That's sick. Sick. Alright, we'll wrap it up. Have a great night, everybody. If you're watching on YouTube, give that thumbs up button, and I'll see you all tomorrow.